Every month, the payment goes out. Every month, a number leaves your account and lands in someone else's. Every month, you tell yourself one of two stories about that number. Either you're throwing it away on rent, or you're building something you'll own. Same amount of money, leaving the same account, on the same day. And yet one of those stories is supposed to make you the fool, and the other the responsible adult. Here's the obvious part. Renting means paying for a place you'll never own. Buying means every payment chips away at a mortgage until decades later, the house is yours and worth more than you paid. That's the folk wisdom, and it isn't wrong so much as it's incomplete. Because what's less obvious, what almost nobody actually runs the numbers on, is that a large slice of every mortgage payment is also money you'll never see again. It vanishes exactly like rent does. You're just not told to feel bad about it. Every dollar you spend on housing splits into two streams. One stream buys you a piece of an asset you keep. The other simply pays for the privilege of having a roof, and then it's gone. Renters can see their disappearing stream perfectly. It's the whole check. Owners are trained to see only the asset stream and to quietly ignore the rest. The real rent versus buy question was never rent versus mortgage. It's which arrangement lets more of your money stay yours. Get this mechanism into your head, and a mortgage payment stops looking like buying a house. You'll watch it break apart in real time into the part that's actually building equity and the part that's just rent wearing a nicer costume. Start with the clean version, the one that makes buying look like an obvious win. You take out a 30-year mortgage. Every month you make a payment. Part of it is interest, the fee for borrowing, and part of it pays down the balance you owe. That second part is equity. It's yours. Over 30 years, you slowly convert a debt into ownership, and at the end, you're holding an asset worth hundreds of thousands of dollars, free and clear. The renter down the hall spent those same 30 years making payments too, except at the end they own exactly nothing. Same effort, same monthly outflow, wildly different ending. In this model, buying isn't just better, it's the only rational choice, and renting is what you settle for when you can't scrape together a down payment. It even feels like a mechanic you'd recognize, a passive resource generator that quietly ticks up in the background whether you're paying attention or not, while the renter's meter stays flat at zero. Except that meter isn't ticking nearly as fast as you think. And the reason why is buried in the one line of the mortgage almost nobody reads. When you sign a 30-year loan, the payment stays roughly level the whole way through. But how that payment splits between interest and equity does not stay level. It's brutally lopsided at the start. In the early years, the overwhelming majority of what you pay is interest, pure fee. Money handed to the bank for the service of lending, building you no ownership at all. The equity portion in those first years is a trickle. It takes many years, frequently well over a decade on a standard 30-year loan, before the split even reaches the halfway point, before you're finally paying down more principal than interest. So for the entire early stretch of ownership, which, not coincidentally, is about how long a lot of people stay in a house before they move, most of your building equity payment is doing nothing of the kind. It's rent. You're renting money from the bank instead of renting an apartment from a landlord, and in both cases, the payment evaporates. And interest is only the first leak. Owning a home comes with a whole set of costs that build you zero equity and never come back. Property taxes. That's rent you pay to the government every year, forever, even after the mortgage is gone. Maintenance, the roof, the furnace, the water heater, the thousand small deaths of a physical structure, which over time runs to a meaningful percentage of the home's value every single year. Insurance, and the closing costs you paid just to get through the door. None of it touches your equity, all of it disappears. Stack it together, and a large share of the monthly cost of owning is simply a second rent check, one you were never taught to notice because it doesn't come with a landlord's name on it. So here's the number that actually decides rent versus buy, and it's not the one on the listing. Strip a house down to only its unrecoverable costs, the money that vanishes no matter what, and you get a surprisingly clean way to compare. On the owning side, there are three: the property tax, the maintenance, and the cost of the capital you've locked up. That last one is the piece almost everyone forgets. The money you sink into a down payment isn't free just because you're not paying interest on it. It's money that could have been invested somewhere else, compounding, and isn't. That foregone return is a real cost. Economists call it opportunity cost, and it's every bit as expensive as a bill you actually pay. It just never shows up on a statement. Add those three together, tax and upkeep, and the foregone return on your capital, and as a rough rule of thumb, they tend to land somewhere around 5% of the home's value each year. That 5% is your true cost of owning. It's the owning side version of rent. Now hold it up against a year of actual rent for the same place. If annual rent sits well below that number, renting is quietly the cheaper way to put a roof over your head, and the gap is money you could be investing. If rent runs above it, owning pulls ahead. That one comparison does more work than any "renting is throwing money away" slogan ever could. Put real numbers on it and it gets vivid. Picture a house that costs $300,000. 5% of that is $15,000 a year. Call it a little over $1,200 a month just to own it before a single dollar goes toward equity. That's the true monthly cost of the roof. If you could rent the same place for less than that, renting is literally the cheaper shelter, and every month you're not paying the gap is a month you're free to invest it instead. There's an even faster version of this test that skips the arithmetic entirely, the price-to-rent ratio. Take the price of a home and divide it by a full year of rent for something comparable. A low ratio means homes are cheap relative to renting, and buying tends to win. A high ratio means you're paying a steep premium to own the same four walls you could rent, and renting while investing the difference tends to win. And if you caught Tuesday's episode on housing supply, you already know what pushes a ratio that high. When a market can't build new homes fast enough, prices get bid up faster than rents can follow, and that widening gap is exactly what this ratio captures. The supply constraint you studied from the outside on Tuesday shows up on Friday as a single number sitting on your own decision. One that tells you which side of the trade the market is offering and cuts through every emotional argument about pride of ownership in about 10 seconds. And here's what that does to your money in a way you can actually feel. The rent versus buy decision was never really about whether you end up owning a house someday. It's about how much of your housing payment, the single biggest line in most people's budgets, is compounding for you versus evaporating, and for how many years you're locked into that split before it ever flips. Choose wrong for your situation, and you can spend a decade handing most of your investment straight to interest, taxes, and upkeep, while a renter who put the difference into the market quietly ends up ahead. Choose right, and the same monthly outflow builds a real asset. Same money out the door, completely different destination. But there's a trap sitting underneath all of this, and it has nothing to do with the monthly math. Buying and selling a home is expensive in a way that renting simply isn't. Between closing costs, agent commissions, and taxes, moving into and back out of a house can quietly cost several % of the price on each end. That's a toll you pay just to enter and exit the position, and it can easily swallow the first few years of equity you built. Which means owning only pays off if you stay put long enough to earn that toll back and then some. Buy a house and sell it 3 years later, and there's a real chance you walk away with less than you put in, even if the price technically went up. Say the round-trip toll runs 6% all in. On that same $300,000 house, that's $18,000 gone to friction alone, money that has nothing to do with whether prices rose or fell. The home's value has to climb past that toll before you've even broken even on the transaction. And in the early years, when your equity is still barely a trickle, there's almost nothing underneath to cushion it. The math only works on a long horizon. Think of it as a steep re-entry cost every time you move. A build that depends on constantly relocating is a build that bleeds resources on every transition. Ownership rewards standing still. Now, if owning has all these hidden leaks, you might expect renting to just win outright. It doesn't. And the reason is leverage. When you buy with a down payment, you control the entire value of the house while having put down only a fraction of it. If the home appreciates, your gain is calculated on the whole thing, not just the slice you paid for. That's an amplifier. Put down a fraction, control the whole. It's about the closest thing personal finance has to a damage multiplier build. When housing rises, leveraged owners look like geniuses. But amplifiers cut both ways. The same leverage that magnifies your gains magnifies your losses, and the housing collapse of 2008 was the entire world discovering that at once. People who'd put almost nothing down watched prices fall, and because they were leveraged, a modest drop in the home's value wiped out their whole stake and kept going. They owed more than the house was worth. Leverage is a glass cannon build, enormous upside, and a failure mode that takes the whole run down with it. So who actually comes out ahead? Not who you'd guess. The textbook winner is a very specific person, the renter disciplined enough to take every dollar they save by not owning, and feed it straight into the market year after year without flinching when it drops. That person can absolutely beat the homeowner over a lifetime. The problem is, that person is rare. Almost nobody behaves like a spreadsheet. And that single fact quietly flips the entire contrast, in a way the clean math never sees coming. And then there's the quiet twist that undoes half the theory. The clean comparison assumes the renter takes the money they save and invests it, puts the difference to work in the market so it compounds. On paper, that renter often comes out ahead. In practice, most renters don't invest the difference, they spend it. And this is where owning claws back an advantage the math never granted it. A mortgage is forced savings. It's an automated grind that runs in the background whether or not you have the discipline to do it yourself. The homeowner builds wealth not because owning is mathematically superior, but because the structure forces a behavior most people can't sustain on their own. There's real irony in that. The supposedly irrational choice ends up building more wealth than the rational one, purely because it removes the human from the loop. This is the flip I promised a minute ago. The people who think they're winning by renting are often quietly losing because the money they saved leaks away into life instead of into investments. And the people who think a mortgage is just another bill are accidentally building the one asset they never had the discipline to build on purpose. Step all the way back and the whole picture reorganizes itself. A house was never one purchase. It's two things bolted together and sold as one. A place to live, which is pure consumption, and a leveraged bet on real estate, which is an investment. Renting simply unbundles them. You buy the shelter and skip the investment. Neither is automatically smarter. What actually decides it is a handful of variables you can now name: how your true cost of owning compares to a year of rent, how long you'll realistically stay before that transaction toll comes due, what you'd genuinely do with the capital a purchase would tie up, and how much you value the freedom to move. Because liquidity, the ability to leave, isn't a weakness of renting. It's a feature you're paying for, the same way an owner pays for the chance at leveraged gains. If this is the kind of breakdown you want more of, systems pulled apart until you can see the actual gears turning underneath, subscribe to 8-Bit Economics. No hype, no predictions about where prices are headed next, just the underlying code of how these systems really work. If this changed how you see your own housing payment, hit like so it reaches the next person still running the old math. And leave a comment with your read. Given everything here, does the rent versus buy answer come down to the numbers, or to knowing yourself well enough to predict your own behavior? Because by the time everyone sees it coming, the smart play is already over. So the next time someone tells you that renting is throwing money away, you'll know the real question was never that simple. Every housing payment splits in two: one stream you keep, one stream that's already gone. The only thing that ever mattered was learning to see which is which before you sign. Owning doesn't make you responsible. Renting doesn't make you a fool. The mechanism doesn't care about the story you tell yourself. It just quietly sorts your money into kept and gone, month after month, whether you're watching or not.